Hey everyone, it's Spencer Hakimian and welcome back to Friday's edition of What's Moving Your Money. On today's episode, we are obviously going to be covering today's awful job report, what lies ahead next week as the Federal Reserve begins to cut interest rates. We are also going to be talking about the market reaction to all of this. And finally, we're going to do a preview of Q3 earnings. They are only 30 days away, believe it or not. So sit back tight and I hope you guys enjoy. So today's job report came out for the month of August and it showed that the United States only added about 25,000 jobs against estimates of 75,000 jobs. Now on top of that, last 2 months jobs reports were revised down another 20,000 jobs on top of it already being negative. So July of 2020 was actually the worst jobs report that we've had in the United States since the pandemic. Think about that. July of 2025 was as bad of a job report as we have had in 5 years as a country. Now, one thing that I think is very important here, and we highlighted it on yesterday's episode, was that the unemployment rate is beginning to rise. We are now at 4.3%, which was above the estimate of 4.2%, which was above last month's rate of 4.1%. We are beginning to see the unemployment rate rise. As job listings get taken off the table and as more people become unemployed, that unemployment rate will continue to rise. People that leave the workforce right now do not have any way to get back in. New college entrants, graduates do not have a way to get back into the labor force or to even get in at all. And that is a big problem because that is how the unemployment rate rises. It's not just from layoffs, it's also from people that enter looking for a job and can't find one, and they are doomed over time. And these things take quite a while to fix. So we are likely going to be in a very weak job market and therefore quite weak economy for the foreseeable future. Now, let's get to what the Fed is going to do as it regards to all of this. The Federal Reserve has their meeting next week and they will be cutting interest rates. It depends if it's 25 or if it's 50 basis points, but regardless, they will be cutting interest rates. One thing that I want to stress here on this channel, if you follow me on TikTok, if you follow me on Instagram, if you follow me on Twitter, you see I talk about this like a broken record all the time. Fed rate cuts will not do that much here to fix it. This is not a problem of access to credit. This is not a problem of credit being too expensive. This is a problem of companies are so uncertain with the economic environment and companies' profit margins are being so substantially hurt by tariffs that they are not hiring new workers. This has nothing to do with monetary policy. And when the problem does not start with monetary policy, the problem cannot be fixed with monetary policy. A giant mistake that we make in this country is that we think the Federal Reserve can fix everything. The Federal Reserve can fix things when it is a monetary problem. Federal Reserve can fix things if they are willing to massively expand their balance sheet. The Federal Reserve can fix things when inflation is below target and they can pump money into the economy to push it back to target. That is when the Federal Reserve can fix things. The Federal Reserve can't fix the fact that businesses don't want to hire. The Federal Reserve can't fix the fact that people don't want to travel internationally into the United States. The Federal Reserve cannot fix the fact that people are afraid of getting laid off and they are therefore not spending their money. That is not going to get fixed with a rate cut. So yes, we will be cutting rates, but how much will it actually help the economy? I doubt it will impact the economy in any meaningful way, and therefore we need other solutions to these problems. The most obvious solution is to roll back these tariffs. Of course, if we were to roll back these tariffs, yes, we will have lost a lot of credibility as a country and as a trading partner, but these problems will slowly begin to reverse. Will we do that? Of course we won't, so we're gonna have to think about other ways to go about this. Now, I want to talk about the market's reaction to today's jobs report because it was classic recession trade. Stocks were down, treasuries rallied, gold rallied, Bitcoin was down. Commodities like oil was down, right? Any risk asset relating to the growth of the economy got hammered today. As the labor market deteriorates, consumer spending deteriorates. And as consumer spending deteriorates, the next logical step is for profits to deteriorate, which means asset prices in theory go down, which is why you saw risk assets, the NASDAQ, Bitcoin, oil stocks, you saw them getting hit hard this morning because traders are beginning to price in the fact that we may be in an actual recession already, as I have been saying for months, and I was getting laughed at online for months, but it looks like it's here and it looks like it's consensus at this point. Now, on the other hand of that trade, you had treasuries and gold rallying. This is why I always stress diversification, uncorrelated diversification. Own assets that do well, not just when the economy does great, but also when the economy does bad. That is how you become a good investor, by owning all the different types of assets, stocks, bonds, gold, crypto, oil, you name it. You got to own all of it if you want to have a properly diversified portfolio that does well in all weathers. One thing that is causing this severe rally in gold is it's twofolded actually. One is all this economic uncertainty, the traditional way. Two is the fact that we are cutting the front end of the yield curve so aggressively in the coming few weeks and months. Gold rallies because gold has an opportunity cost, and when you can earn less interest on your money in a bank, then why not own a little bit more gold? So that is one of the reasons why we are seeing gold rally, and you will see funds when they put out their 13Fs, you will see increased allocations to gold. Believe me, this always happens. It is the most cyclical and repetitive thing in markets. People get late to these trades and then they pile in once they realize, oh God, we got to get exposure. Now, to end today's episode and this week's podcast, let's just briefly talk about Q3 earnings, which are only 30 days away at this point. I'm not sure how Q3 earnings are going to be, but what I am sure is that Q4 guidance, if it is given, is not going to be that nice. It is not going to be so good. You already see it with companies like Lululemon, like Walmart, like UPS, like FedEx, like any of the bellwethers, like John Deere. Every company that is guiding for the future is saying it's getting ugly for them. The only companies that are reporting better guidance than expected are the AI companies. And we've done an episode already, and I'm going to do another one next week about how we are in this K-shaped economy. We have the AI tech leaders and they're doing great. And then we have everyone else who's struggling and hanging on by a string. For today's episode, that's going to wrap it up. And I want you guys to comment what your thoughts are. And I look forward to seeing you guys next week.